Dividend stocks are a fantastic way to get access to true passive income, but most of these stocks have one problem. They don't pay as consistently as some other investments, such as real estate. Most stocks pay 4 times a year or once every 3 months, and although for most investors this isn't a big deal, for older investors, especially retired ones who need the income, this can make planning out expenses far more challenging. The solution to this is very simple. It is monthly paying dividend stocks. Not only do these make planning expenses more simple, but they also compound faster as the dividend checks hit every single month. That is why in this video, I'm going to go over my 3 favorite monthly dividend stocks that could really help get the snowball rolling in any dividend portfolio. Anyways, let us get right into it. Before we start this video, make sure to like and subscribe if you're new to the channel because I will be posting dividend stock videos just like this one every few days. Monthly dividend stocks are usually high yielding, and that is definitely the case with the first stock on this list, Main Street Capital Corp, ticker MAIN. This company is a BDC that yields just around 7%. Despite the high yield, Main has had a consistent track record of providing reliable income to investors that also grows pretty consistently. Because Main is a BDC or a business development company, they primarily invest in a diversified portfolio of small and mid-sized businesses across different industries, as well as offering debt solutions, creating a well-balanced approach to income generation. Main definitely has a very solid portfolio, and when compared to some other BDCs, it is quite stable because of it. The dividend history with Main is quite impressive as well, as they rarely cut or miss a payment, ensuring that shareholders receive regular, predictable cash flows, making it an attractive choice for those seeking financial stability and dependable income to meet their monthly financial needs, as I was mentioning earlier in this video. Main's reputation for stability and strong performance in the market further solidifies its status as a preferred monthly dividend stock for investors looking to build a sustainable income stream over the long term. Speaking of the dividend, Main has also grown its dividend very consistently over the long term. It has a 10-year dividend CAGR of 3.97%, and the most recent hike was actually more than this, sitting at 5.26%, which is always a good sign. Although these hikes are pretty small, relatively speaking, especially in the world of BDCs, these hikes are definitely pretty solid. One thing that is also definitely a bonus is their special dividends. Main, unlike most companies, pays a special dividend pretty often. These dividends aren't often huge, but when they happen, do make it so you get paid twice in 1 month, which is always an added bonus. Overall, as far as monthly paying BDCs go, Main is probably the best one out there and is a dependable monthly paying stock that I think is worth paying attention to. BDCs can often be pretty cyclical though, so being able to pick up a share for under $38 in my opinion is a very great deal and is a good way to even out your dividend income and add to your income overall. The second stock on this list is Realty Income, ticker O. This stock is one that is extremely popular amongst many dividend investors, and the stock has seen a lot of coverage in recent months, mainly due to its big drop this year. Year to date, the stock is down over 20%, which definitely isn't great, and its recent acquisition of Spirit Realty temporarily pushed the shares even lower. This, however, has created an interesting buying opportunity. The stock is currently cheaper than it was 5 years ago, so if you've liked this company in the past but have thought it was too expensive, then now is definitely a pretty good time to get in. Because of the drop, the stock currently yields over 6%, which is well into high yielding territory, which I consider to be over 4.5%. The stock is also a dividend aristocrat, which means that consistent, albeit small, dividend hikes should be expected going into the future months and years. Also, because of the monthly payments, investing in Realty Income is kind of like buying your own mini property and receiving rent checks. However, the stock, unlike the property, requires no maintenance and is truly passive. The stock is a 10-year dividend growth CAGR of just over 4%, which definitely isn't too bad. Despite all this good news though, it is still worth noting that the recent fall has been down to a few legitimate reasons. Firstly, some of Realty Income's largest tenants, such as Walgreens, face some pretty heavy issues. This has caused major concerns that they'll be unable to pay Realty Income's rent and will be forced to close locations, leaving Realty Income with less revenue. This issue, though, isn't as big as I think it is being made out to be. Realty Income's properties are high quality and are in demand, which is why they have such a high occupancy rate. So even if a company like Walgreens was to remove many of their locations, Realty Income probably wouldn't have a super hard job finding new tenants. Also, most of Realty Income's tenants are high quality and reliable payers, meaning that they almost always pay on time, so them not paying at all is super unlikely unless something major is to shift within the retail industry. To put this into perspective, the COVID-19 pandemic, which weighed heavily on some retail stores, only temporarily pushed Realty Income stock price this low. And if Realty Income's tenants can survive COVID-19, they can probably survive a lot of bad environments. The other big issue facing the company, though, is high interest rates. Since REITs pay out a lot of their profits to shareholders, it can be very difficult to acquire the funds necessary to buy new property or, even harder, build new property. This forces REITs to take money out on loan, but that is currently extremely difficult due to the high interest rate environment without jeopardizing the company in the long term. This has caused a major slump in Realty's asset growth, so they have been forced to issue new shares to generate capital. The big issue with this is that it dilutes existing shares in the process, which is definitely a bad practice for shareholders. This practice makes it so that your existing shares are worth less of a percentage of the company, making them worth less overall. Generally, I'm not a huge fan of Realty Income, but I do absolutely see some of the upside. Monthly dividends, dividend aristocrat status, and high yield are all great things, and that is why it is the second stock on this list. The last stock on this list is another REIT. It is Stag Industrial, ticker STAG. Stag Industrial is a REIT for investors seeking stable income and growth potential. This company specializes in the acquisition and management of single-tenant industrial properties, a sector that currently has super strong fundamentals because of the rapid growth of the e-commerce industry, increased demand for logistics and distribution centers, and a thriving manufacturing industry. Some of Stag's largest tenants are Amazon, FedEx, and XPO Logistics, which back up what I was just mentioning. Moreover, the company's long-term net lease agreements with tenants provide a consistent and predictable stream of rental income, making it an attractive choice for income-focused investors who don't really want to worry about potential dividend cuts. With a strong track record of consistent dividend payments and a commitment for shareholder value, Stag seems like a great choice. Unlike Realty Income, Stag is up over 6% year to date despite the negative environment weighing down on REITs, showcasing their growth potential. The stock, though, is still down majorly from their all-time highs, though, potentially providing a buy point for new investors. However, it is worth noting that Stag, by far, has the lowest dividend yield out of any company on this list. They currently yield just around 4.3%, which for many income investors who need the cash is simply too low, and that is also yielding less than bonds right now. In addition, their dividend growth is hugely low, with the dividend CAGR sitting in the mid 1% for the past 10 years as it genuinely barely grows. This does make it so the dividend yield over time has gotten smaller as the stock prices increased, which is definitely a bit worrying. The tenants under Stag are definitely impressive, but the low growth on the yield isn't fantastic, and the lower starting yield makes it, in my opinion, a worse buy than Realty Income. However, Stag hasn't had the same share distribution issues plaguing Realty Income, and also in my opinion, they have the more future-proof tenants, which is definitely a big plus. Thank you guys for watching this video. If I had to buy just one of the stocks in this video, it would absolutely be Maine. I could be a little biased because I'm not a huge fan of REITs, but I think out of the three, that one is definitely my favorite. Also, my reviews of the stocks in this video were definitely a bit short to try and keep the video nice and short, so if I left out anything important, let me know down below in the comment section. The purpose of this video is really just to expose investors to some of their options when it comes to monthly yielding stocks. Anyways, I will see you all in the next video. Thank you so much for watching, and goodbye.